What blindsides people in silver is almost never the direction. It's the speed. One moment it looks tidy, even boring. Then the market doesn't move, it changes state. Bids don't step back, they vanish. Spreads don't widen, they rip. Silver has a talent for reminding everyone that confidence is rented, not owned. And right now, we were in one of the most dangerous phases a market can enter, the quiet decision window. The surface looks calm enough that people assume stability, but calm in silver is rarely peace. It's tension, a coiled spring pretending to sleep. Your screens can show an orderly price, while the real game, availability, delivery terms, and the willingness to offer size, shifts underneath. And that's why the title matters, the unseen move. What silver will do right after 85 breaks is not just a chart question, it's a structure question. Because 85 isn't magical by itself, it's a line in human psychology. It's a level where positioning flips, where risk managers start calling, where hedges get rebalanced, where retail becomes convinced the move is confirmed, and where the market either rewards patience or punishes hesitation. The problem is, silver doesn't give perfect entries. It doesn't hand out safe consensus. It forces decisions under uncertainty, then punishes people who demand comfort before acting. Over the last several sessions, something happened that most people are misreading. The easy story is panic selling or weak hands. That story is comforting because it makes everything emotional and random. But the fingerprints don't match. Real liquidation has a signature, physical premiums collapse, dealers get flooded, supply reappears, and everyone is desperate to sell. This time, the paper price absorbed pressure, but physical demand didn't fold the way it does in genuine capitulation. That divergence is not noise, it's information. When the paper market weakens and the physical market refuses to break, it often means the selling is being used strategically, not feared. Someone with patience is letting the visible price soften while quietly securing supply where it matters. That's not drama, that's procurement logic. And procurement logic doesn't care about your moving averages. It cares about securing metal without signaling urgency. Why does this matter for 85? Because when silver finally clears a widely watched level after a period of controlled stress, the next phase isn't usually a clean climb. It's a repricing event that changes behavior. You start seeing offers pulled faster. You start seeing size harder to locate. You start seeing yes but terms attached to what used to be straightforward transactions. Price becomes less important than access. And once access becomes the trade, volatility changes character. It stops being random and starts being structural. We're going to break down the unseen move in 5 steps. First, what the market has been signaling through behavior, not headlines. Second, why silver's physical demand is rigid and why that creates asymmetry. Third, what a true break above 85 triggers in positioning and liquidity. Fourth, what it looks like when access replaces price as the primary variable. And fifth, what you should watch immediately after the break to tell whether the move is a fake-out or a regime shift. Disclaimer, this is educational analysis, not financial advice. Now let ES start with the core idea that most people still have at T internalized. Silver is a small market, and small markets snap. Silver's first secret is arithmetic. It's not a deep market like equities. It's not a giant reservoir like bonds. It's smaller than most people assume, especially in terms of tradable float, the metal that is actually available to be bought and moved without friction. That SY moves that would look like background noise elsewhere can shove silver into a different universe. There isn't an endless wall of patient sellers waiting to cushion transitions. When direction changes, silver doesn't glide. It snaps. And because it snaps, people interpret it emotionally. They assume there must be panic or manipulation or some dramatic catalyst, but often it's simpler. The float is thin and the pressure is real. This is why the divergence between paper and physical is so important. Futures markets are shock absorbers. They can absorb emotion, dumping, and hedging activity without immediately reflecting true scarcity. Physical markets can't do that for long. Physical markets have to deliver metal. If metal is harder to source, the physical layer starts expressing that reality through premiums, delivery timelines, and willingness to quote size. When paper gets hit but physical doesn't collapse, it's the market telling you quietly that the metal is wanted. And the people who want it are not just speculators, they're users. Industrial demand for silver is not negotiable. Solar manufacturing doesn't debate charts. Medical equipment doesn't wait for a better entry. Defense procurement doesn't care that your RSI is overbought. You can delay buying a stock. You cannot stop a production line without costs that dwarf the cost of the metal itself. That creates a structural floor that behaves differently than sentiment-based support. In other words, some demand will pay up quietly because the alternative is operational failure, missed contracts, and cascading losses. This is why silver's suppression phases rarely end in a gentle fade. They end abruptly. The market can ignore value for a long time, but it cannot ignore necessity forever. When financial stress collides with rigid physical demand, one side bends. It's rarely the industrial side. Industrials adjust by paying premiums, locking supply, and pulling forward purchases. They don't announce it, they just do it. And those actions create the unseen move, quiet accumulation during visible weakness. Because if you need silver, you don't chase it with a spotlight. You use volatility as cover. So what happens near a major level like 85? A level like 85 acts as a narrative magnet. It collects attention. It attracts options positioning. It becomes a trigger for systematic strategies. It becomes a psychological border between maybe and confirmed. But here is the twist. When silver breaks a narrative level after a period of controlled stress, the break itself can create its own shortage, not because the world suddenly needs more silver, but because everyone tries to secure access at once. Many participants are complacent below the breakout. They assume they have time. They assume liquidity will be there when they decide to act. Then the breakout happens, and they discover the truth. Liquidity is a luxury that exists only until it's tested. So the unseen move is often not price goes up. Its availability changes. Offers shrink. Quotes come with conditions. Size becomes harder. Deliveries stretch. And suddenly, the market feels different even if the chart doesn't fully show it yet. This is why the first question after 85 is not how high. It's how real is the metal flow. Now, to understand what happens right after 85 breaks, we need to talk about two things that control silver-S behavior in this phase: positioning and liquidity. Positioning is the invisible engine behind the visible chart. A lot of silver ES violent moves occur when positioning is lopsided and the market is forced to rebalance fast. This is where people misunderstand volatility. They think it's chaos. But in many cases, it's forced behavior. Stop orders trigger. Margin requirements change. Options dealers hedge. Systematic funds react to volatility regimes. Funding costs move. Entire categories of participants are compelled to act, not because they have new opinions, but because their rules demand it. When 85 breaks, you get a chain reaction in 3 layers. First, the technical layer. Breakout traders jump in, stop losses above resistance trigger, momentum systems flip. Second, the derivatives layer. Call open interest can force hedging flows, and short gamma conditions can amplify moves. Third, the physical layer. Buyers who were patient become urgent because they fear the window is closing. That third layer is the one people underestimate because it doesn't show up as a giant green candle at first. It shows up as the market's willingness to sell you metal changing. Right after a major break, one of the most important questions is whether the breakout is being sold into with real supply or whether it cess being endured with paper hedges. If real supply shows up, premiums relax, availability improves, spreads normalize. That suggests the market still has slack. If supply does not show up and instead we see paper selling while physical remains firm, then you are watching a regime shift. The market is using paper to manage optics while the physical layer tightens. That S, the moment where price discovery becomes messy because the headline price is no longer the whole truth. There's also a behavioral trap here that silver loves. After a violent move, markets often enter a hesitation phase. Buyers hesitate because what if it drops again? Sellers hesitate because what if it runs? Volume dries up. Volatility compresses. From the outside, it looks like calm. People mistake that calm for stability. It's not stability, it's indecision under stress. And silver is dangerous here because it can jump out of that compression without warning, skipping levels, creating slippage, turning neat plans into regrets. This is why the right after 85 breaks window matters so much. The first 24 to 72 hours after a breakout can tell you whether the market is transitioning to a higher equilibrium or just doing a temporary head fake designed to exhaust participants. The market leaves fingerprints in how it behaves when it should be easy. If 85 breaks and the market immediately becomes hard to buy in size without pushing price, that's a clue. If 85 breaks and premiums stay stubborn, that's a clue. If 85 breaks and dealers become less enthusiastic about quoting delivery, that's a clue. If 85 breaks and the basis structure begins to behave strangely, that's a clue. These are not dramatic signals. They're plumbing signals. And silver transitions rarely announce themselves with a press release. They announce themselves through absence. The offer that used to be there simply isn't. Liquidity that felt reliable suddenly feels thin. And the participants who don't have the luxury of waiting, industrial buyers, large allocators, start acting like time matters. That's where the unseen move becomes visible in behavior, not headlines. Now, let us talk about why 85 is a special kind of trigger in this environment. Not because it is a round number, but because it's a threshold where the market's story changes. Below 85, the market can still pretend it's in the old regime. It can pretend volatility is temporary. It can pretend the last drawdown was just positioning. It can treat physical tightness as anecdotal. Above 85, the story becomes harder to manage because too many models and narratives begin to fail at once. An upside break threatens shorts. It forces hedges. It draws attention. It increases the probability that participants demand delivery instead of exposure. And when that probability rises, leverage becomes dangerous. Because the silver market has always lived with a high paper-to-physical ratio. Multiple claims can exist on the same ounce, as long as most people treat those claims as good enough. That system works in calm conditions. But when even a small percentage shift from exposure to possession, the math strains. That's not conspiracy, it's structure. And structure determines how a market behaves under stress. Here's the key concept. Healthy markets advertise liquidity. They invite participation. They boast about depth. Stressed markets ration liquidity. Offers appear briefly, then disappear. When they return, they're smaller. When conditions tighten, the market starts pricing certainty of delivery higher than saving a few dollars. That's when access becomes the trade. It's also when the public gets confused because the screen price might not immediately reflect the full stress. They'll ask, if supply is tight, why isn't price exploding? Because price is being managed through the paper layer while the physical layer tightens quietly. This is what controlled stress looks like. Futures absorb pressure. Physical refuses to collapse. That divergence is not random. It tests the market. That's a way of telling you that the metal is being desired without being chased publicly. And this is why the first move above 85 can be deceptive. It might not look explosive right away. It might look like a normal breakout. Then suddenly you notice the details. Spreads widen in odd ways. Immediate delivery becomes harder. Small quantities still appear, but size becomes scarce. And premiums remain stubborn even as the screen price tries to shake people out. That is the unseen move. The market is sorting who ends up with real metal and who ends up with paper claims that behave nicely until the exact moment you need them to behave perfectly. A major break can also change behavior in industrial procurement. In a calm regime, manufacturers can buy spot, hedge, and manage inventory lean. In a stressed regime, they build buffers. They lock supply. They sign longer contracts. They pay up to secure certainty. Buffers remove metal from circulation, which tightens the market further. This is how supply cliffs form. Not with sirens, but with quiet withdrawal. Sellers step back methodically, not because they hate money, but because they sense a shift and don't want to be the ones who sold too early into a repricing event. Now, none of this implies a clean parabolic move. Silver hates clean fantasies. It punishes them. It whipsaws. It tests your patience. It humiliates certainty. But it does suggest that risk is becoming asymmetric. Downside at these levels is often driven by sentiment and positioning, forces that can be manufactured, extended, and distorted. Upside is anchored in necessity and physical constraints, forces that cannot be postponed forever. These forces are not equal. One can be delayed indefinitely by psychology. The other eventually asserts itself because it's tied to real-world usage and availability. This is why the period right after 85 breaks can change everything. It's when the market stops rewarding denial. Now, let's get specific. What does silver do right after 85 breaks, in practical terms? What patterns have we seen historically, and what signals separate a fake breakout from a true reset? Right after 85 breaks, silver typically does one of three things, and each one tells you something different about the regime. First pattern, breakout, then immediate pullback that holds above the level while physical stays firm. This is the healthiest version. It suggests the market is repricing to a new floor and absorbing profit-taking without releasing physical stress. If premiums remain stable and size is still hard to get, that's a strong message. The paper pullback is not loosening the physical layer. Second pattern, breakout, then violent snap higher with gaps and messy candles. This usually happens when positioning is lopsided and liquidity is thin. It's not fundamentals changing overnight. It is the market realizing it cannot meet demand at the new attention level without repricing fast. In this pattern, the unseen move becomes visible quickly because the market stops pretending it has depth. Third pattern, breakout, then sharp rejection. Back below the level with aggressive paper selling, but with physical premiums refusing to break. This is the most deceptive scenario because it looks bearish on the screen, but the structure can remain bullish. If physical refuses to fold, it means the metal is still being absorbed quietly and the paper market is being used to create doubt and shake out late buyers. That scenario often sets up a later move that is even more violent because it exhausts participants and lures them into complacency before the next leg. If you want to know which pattern you're in, stop watching only candles. Watch behavior. Watch whether offers reappear after the break. Watch whether dealers widen spreads. Watch whether immediate delivery is treated as a premium service. Watch whether large size becomes difficult to quote without conditions. Watch whether the market becomes stingy with metal even when price is soft. That stinginess is the true signal of tightening. Not hype, not memes, not opinions, but the cost of certainty. Because once certainty is priced, the market's character changes. Price becomes less of a negotiation and more of a rationing tool. And rationing is how commodities enforce reality. Now, let's address the biggest trap people fall into at this stage: waiting for perfect confirmation. People tell themselves they'll act once 85 is cleanly broken, once it holds for a few days, once everyone agrees, once the breakout feels safe. But silver doesn't reward safety-seeking behavior. Confirmation usually arrives packaged as higher prices, thinner liquidity, and worse terms. That's the price of comfort. Silver forces decisions when the information is incomplete and the crowd is uncertain. This is why the best long-term operators in silver are not the ones calling exact targets. They were the ones recognizing windows, opportunity corridors that narrow quietly, then acting with disciplined sizing and patience while everyone else argues about noise. The unseen move is exactly that, a narrowing corridor. As price approaches and crosses 85, the corridor can narrow fast, not because the world changes overnight, but because people's behavior changes. They stop selling as easily. Buyers become more urgent, and the market begins to ration the metal. That's when the conversation shifts from, is silver undervalued, to, can I secure it when I need it? And that is always late cycle behavior in a physical commodity with rigid demand. So here's the clean conclusion. Silver after 85 breaks will likely do what it always does during transitions. It will test resolve. It will create discomfort. It will make the most emotionally safe choice look smart right before it becomes expensive. It will tempt you to wait for the perfect setup, then punish delay with gaps and pulled offers. And it will communicate the regime shift the same way it always does, through absence. Not with headlines, through the offer that used to be there and suddenly isn't. If you want the one-sentence summary, it's this. After 85 breaks, the market stops selling comfort and starts selling access. And access is the trade when physical reality begins overriding paper confidence. If this framework helped you, stay close, because the next video will break down the exact plumbing signals that confirm a true reset. The spread behavior, the leaf structure, and the physical premium divergence that paper can't fake forever. Until then, don't chase noise. Watch behavior. Because in silver, behavior is the truth.